As a futures trader, mastering the intricacies of mark-to-market is as crucial as understanding leverage or the underlying asset itself. It's a core component that shapes the daily life of a futures trader, influencing everything from trade strategy to liquidity management. On the other hand, let's examine stock options trading. Let's take a little time to contrast the mark-to-market or daily settlement of the futures market versus the settlement used in the stock market. The settlement used for stocks and options on stocks is called T+2. The T+2 settlement cycle refers to the time frame within which securities transactions must be settled after a trade is executed. This term stands for trade date plus 2 business days. When you buy or sell stocks, the actual exchange of money and shares doesn't occur instantly. Instead, it follows this T+2 schedule. The trade date, often abbreviated as T, is the day when the trade is executed. This means it's the day when the buyer agrees to buy and the seller agrees to sell a security. The settlement date, which occurs 2 business days after the trade date, is when the actual settlement of the transaction takes place. This delay allows the parties involved time to arrange for the transfer of cash and securities. There are several critical reasons for the T+2 system. It helps manage risk by providing time to verify the details of the trade and ensure all parties have the necessary funds and securities. This process mitigates the risk of default by either party. The settlement period also allows for the processing of a large volume of transactions and the resolution of any discrepancies that might arise. T+2 is a standard adopted in global markets, helping to synchronize and streamline international transactions. The shift from older settlement cycles like T+3 to T+2 was made possible by advancements in technology and changes in regulatory practices. These changes were aimed at reducing risk and improving market efficiency. Unlike futures markets, where mark-to-market involves daily settling of gains and losses, stock market trades are settled in a lump sum after a couple of days. This difference reflects the distinct nature of these markets and their respective risk profiles. As we can hear from the previous discussion, the T+2 settlement cycle in the stock market is crucial for ensuring the smooth, efficient, and secure processing of securities transactions. It provides a standardized time frame for the settlement of trades, reducing risks and enhancing operational and regulatory compliance. Understanding T+2 is essential for stock market participants as it influences the timing of cash and security flows and impacts liquidity management. Understanding the differences between these two mechanisms is crucial for grasping how financial markets operate and manage risks. The key difference between the T+2 settlement cycle in stock trading and the mark-to-market process in futures trading lies in the timing and nature of the settlement of transactions. In the stock market, the T+2 settlement cycle dictates that the final transfer of stocks and the corresponding payment occurs 2 business days after the trade is executed. This cycle allows time for verifying trade details and arranging the necessary funds and securities. It is a post-trade process where the actual exchange of assets happens at the end of the settlement period, reflecting the trade's value at the time of the transaction. On the other hand, the mark-to-market process in futures trading is a daily reconciliation of account balances to reflect current market values. Every day, the value of open futures contracts is adjusted to the market's closing prices. This continuous adjustment ensures that gains and losses from futures positions are realized and recorded daily. If the market moves favorably, profits are added to the trader's margin account. Conversely, losses are deducted if the market moves unfavorably. This process not only ensures real-time reflection of gains and losses, but also necessitates that traders maintain adequate liquidity to meet daily margin requirements. While the T+2 settlement provides a brief buffer for stock traders to arrange their finances, mark-to-market in futures trading demands constant vigilance and immediate financial response to market movements. The T+2 settlement cycle is more about finalizing a transaction made at a specific past point in time. In contrast, mark-to-market is about continuously adjusting to the market's present conditions, making futures trading inherently more responsive to daily market fluctuations. These different approaches reflect the distinct nature and risks inherent in stock and futures trading. The T+2 settlement cycle caters to the structure of the stock market, where trades are based on ownership transfer. In contrast, the mark-to-market method suits the futures market, where contracts are based on speculations about future asset prices. Understanding these mechanisms is vital for market participants, as they directly impact trading strategies, risk management, and capital requirements. Stock options trading offers a distinctive approach within the financial markets. It allows traders the right to engage in the purchase or sale of a stock, depending on the type of option they hold. With call options, traders have the right to buy a stock at a price that is agreed upon beforehand. Similarly, put options grant traders the right to sell a stock at a predetermined price. These rights can be exercised within a specified time frame or on an exact date. This element of choice sets stock options apart from the more immediate nature of stock trading transactions and the daily adjustments to valuation that are characteristic of futures trading. When participating in options trading, traders are afforded a significant degree of flexibility. They can decide whether to exercise their options based on the current market conditions and aligned with their individual investment strategies. This flexibility is a stark contrast to the rigid settlement period seen in stock trading and the continuous mark-to-market process found in futures trading. The diverse uses of options include hedging against potential market risks, generating income by collecting premiums, and engaging in speculative activities based on predictions about market movements. An in-depth understanding of stock options and their strategic application is crucial in the realm of modern investing and trading. These options provide a tool of great versatility, fitting into a variety of investment strategies. They offer a level of control and a means of mitigating risk that is typically absent in straightforward stock trading or in the fast-paced and highly variable futures market. This diversification across strategies and financial instruments underlines the complexity and multifaceted nature of financial markets. It opens up a broad array of opportunities for investors and traders to manage risks and explore potential avenues for returns. Stock options trading offers the right, but not the obligation, to buy call option or sell put option a stock at an agreed-upon price within a certain period or on a specific date. Options are used for hedging, income generation, or speculative purposes.